Manpreet Gill, Chief Investment Officer of Africa, Middle East and Europe, Standard Chartered, is our big guest this morning on India Market Open. Manpreet, thank you so much for coming in and speaking to us. We always enjoy our conversations. Let's just start talking about India. If we could just focus on India for the start of this conversation and to set context. Something seems to have shifted in terms of the global view on India over the last few months. I mean, we're seeing it in the fund flows, we're seeing it in the commentary as well. What are you hearing?
No, you're right. There's definitely been a little bit of a step shift in perception, and not necessarily within Standard Chartered. I think we've always had a more constructive view than much of the street. But I think what's changing here is, I think some acknowledgement that, we've seen some slowdown growth, but there is policy support coming through. I think number one is acknowledgement of that. Second is that, it's much more relatively insulated market. I mean, the domestic focus from an earnings growth perspective is valuable at a time when there's many sources of volatility, I suppose, globally. There's still, I suppose, a little bit of focus on the valuation number, which still looks on the more elevated side when you think in relative terms, especially to North Asian equity markets. And I think what's really new more recently is the focus on the softer dollar, because that really starts to improve the outlook for global investors in emerging markets, where India has always been, a big focus of attention. So I think that's really perhaps a snapshot of where we are today, in terms of the broader view. For us, obviously, the constructive view, is very much in place. For us, it's really only a debate within Asia, where we sort of tilt our overweights and views.
Manpreet, the overarching feeling for a lot of people has been that money moves out of US, both from equity markets or risk assets, as also maybe the dollar weakens, and there is some bit of it that has played out thus far. The question is, can more of this happen? Is that more conducive for Asia Pacific markets over a 1-2 year period? And is it really material, this argument and the quantum of it, for an investor to take note of?
Well, maybe to start with that last question, the answer is yes. I think, a weak dollar is quite a material factor when you're thinking about capital flows into Asia Pacific, into emerging market assets. I mean, no matter how far back you go in history, it's a fairly consistent track record that outside of recessions, of course, a weak dollar has generally been good for risky assets, good for equities in general, but particularly good for the relative outperformance of emerging markets of Asia and of non-US assets. And I think that, to me, is quite an important factor, and certainly a big factor into our outlook for the rest of this year and next. I think what we need to do is, of course, in the very short term, just be mindful that we've had one wave of downward pressure on the dollar. We know from many surveys that positioning is quite one-sided, so we might see a little bit of unwinding of that. But that's really a short-term story for the coming weeks. I think if you zoom out and look at the big picture, the dollar is either in nominal terms or in valuation terms at the higher end of its long history. And it wouldn't take a lot in terms of either a little bit more trade pressure or a fall in interest rate differentials to have the dollar move back lower from where we are. But that will only take us back to where we were 4, 5, 6 years ago. And we think that can actually introduce a new tailwind, at least as far as foreign inflows go into Indian equities and indeed into Asia-Pac equities.
Manpreet, I'm just wondering, in terms of clouds on the horizon, headwinds coming in, do you think that the concerns around the July 9th tariff deadline have now dissipated to some extent, looking at the statements from the White House coming in overnight, or is that going to be the next shake-up? In short, since April 2nd, concerns about what tariffs can do, have they receded to the back of, your list of worries?
Not quite the back. I think there is a certain amount of acknowledgement that we're coming up to the next sort of key risk event. But I'd be surprised if we get through it without at least a little bit of noise and volatility, because we know from recent track record that that there is a little bit of back and forth. Look, our base view is that trade negotiations, as long as they're going well, the US and Trump does have an incentive to just extend that in order to keep the process going. But of course, when you look across the range of media reports, you see some mixed noises. I mean, positive noises when it comes to US-China relations, perhaps a little bit of friction when it comes to US and Europe. So what I'd expect is a little bit of rhetoric, which might create a short period of volatility, but nothing more than that. It seems to be an interest of the US and all its major trading partners to continue negotiations and aim to a deal. The other thing I'd add is that, look, perspective, right? In the past quarter alone, we've had obviously initial Liberation Day shock, we've had tension in the Middle East, and now coming up on the expiry of trade tensions. Each of them has created a bit of volatility, but let's not forget, if you look at the global equities benchmark, we're up about over 9% since the start of the quarter, despite all of that. So yes, some volatility is possible. That's what I'd expect. But as a baseline, an extension and a continuation of trade negotiation, I think that's a reasonable assumption.
Okay, Manpreet, we're not looking at India as closely on a bottom-up basis as you may have been doing that before. But the one thing that almost everybody's concurring on is that with the new Reserve Bank of India, if you will, it is quite a new looking and a new acting Reserve Bank of India, that financials seem to be a certain port of call for almost any investor, because the liquidity conditions have improved. They are allowing people leeway to take more risk, and all of that coupled with the government push on growth could mean that lenders have a field day over the course of the next couple of years. Would that be a fair assessment? And would you be, from a 50,000 feet view, constructive on financials in India?
No, absolutely. I'd agree with that. And indeed, that's why financials have been a preferred sector for us in Indian equity markets for, well, I'd say more than a couple of consecutive quarters, and still very much are the case. And I think it's important to point to the two different legs that you alluded to, right? I think one is, I think from a growth perspective, right? Because continued growth is ultimately important, not only for growth of top line revenue, but also for maintaining credit quality. And I think that's almost a requirement. But on the other side, of course, where you have, more policy support, whether it's on the RBI, whether it's more from the fiscal side, I think that is, of course, equally important. I think what we saw from the rate cut perspective, look, by itself, you would argue that leads to a flatter yield curve, perhaps less supportive on the margin. But we think the policy support signal we get from that on the growth side and the credit quality side, we think that's actually the supportive factor. The last point I'd add really here is that, look, in the US, we're still discussing inflation risks. But what's different in India and many other similar emerging markets is there's actually less of that inflation risk, which means more room for central banks to cut rates, just like what we saw the RBI do. So we think that, of course, is what's not fully priced into markets, and we can still be quite a tailwind for the market as a whole, but also the financial sector particularly. So that's within our ranking of sector preferences, still one we like quite a lot.
So BFSI looks smart. I think the biggest confusion and consensus, if at all, Manpreet, I would say, is on IT. And today, for example, midcap IT completely firing. Few days ago, down in the dumps. No one's quite sure where the Indian companies fall in this AI race. What's your take on how some of these companies are stacking up?
So I think technology is a sector we had a big debate on, right? Because I think in today's world, with trade ultimately still being a risk there, right? That all the trade tensions have not been resolved. There's still a lot of uncertainty on the horizon. Our preference was to focus more on sectors like financials or indeed consumer discretionary, which are more insulated from that, focus more on what domestic growth looks like. And that's an approach we take in Indian equities, but elsewhere as well. And that's why we sort of trimmed our exposure back to technology is no longer amongst our top ranked sectors. But I do see the case for, taking sort of, what you mentioned around mid caps, right? I think one lens we're taking, and this is not purely related to technology alone, is sort of saying large caps versus small and mid. We have been fans of large caps over small and mid, simply because we think exposure to growth, but taking a slightly more conservative stance from a relative valuation perspective. But I do see the case for maybe dipping our toes a little further into mid caps, particularly where the valuation earnings outlook looks a little bit better. So while that doesn't target just the technology sector, I think that's another approach which gets you some of what you were describing in terms of technology sector exposure, but more through the mid-cap route rather than a pure sector call, which I think is still a little bit too exposed to trade uncertainty.
Okay. Manpreet, one final question, and that is around the sunrise sectors in India, which have a very large domestic applicability, but they're making their presence felt now globally. Defense, railways, we just saw yesterday or day before a local company getting a large order from a US partner for making locomotives for the US market as well, right? And and then, of course, all that's happening in EMS. So anything out there which is made in India, made for the world, that seems a very compelling story to you?
Well, if I was a stock picker, I'm sure I would have a lot of good ideas for you. But no, I think that theme really applies, right? And I think while you describe a lot of ideas, which I think would be interesting to a stock picker's approach, I think what it really plays into is, what you talk about defense, and I'd zoom out to the industrial sector. I think that's one area we're looking at quite closely, whether in India or elsewhere in other major markets, because this renewed focus on defense spending, we're seeing that around the world, unfortunately, because of recent conflicts. But from an investor perspective, I think that's greater focus that really wasn't there even 6 to 9 months ago. And I think at the moment, I know it's not directly accessible, but European industries are where we're seeing the opportunity from that angle, perhaps more sharply. But I think your point on sunrise sectors in India, new areas, I think that's why, from a sector perspective, we're really looking at domestic-oriented sectors a little bit more, where the opportunities sit. Starting, of course, with domestic demand, many of them, of course, I'm sure we will see many opportunities globally after establishing themselves. But I think that's really where the opportunities, as opposed to, for example, technology, where you've exposed a lot of the risks in today's world. That's also why, look, while in relative terms, our tilt is slightly towards North Asian equities for very different reasons. We're quite constructive on Asian equities, not only because of the dollar and growth, but I think in India, that growth focus coming from sunrise sectors and elsewhere, that's, I think, quite interesting. And in a world where you take away pressure from a stronger dollar, we think that will be a great source of returns over the next year or so.